10 tips to help you avoid capital gains tax on property in California. One of the most common questions people have is, am I going to have to pay capital gains tax on my property? It's a complicated question that depends on what type of property, how much you paid for it, and how long you've had it. Even if you're not in California, there are still capital gains taxes depending on how your property was classified. To make sure you don't run into any trouble with the IRS, here are 10 tips to help you avoid capital gains tax when selling your property in California. Understanding the tax. Capital gains tax is one of the most complicated taxes you could run into. And this is especially true if you're not in California. So what are capital gains? They're defined as any profit that's gained from your property. The IRS has different sets of rules for different types of property, which means that you might be able to exclude certain properties from being taxed. If you've invested in a stock or mutual fund, for example, then your capital gain would be calculated by looking at the difference between what it was worth when you bought it and what it was worth when you sold it. But with property, there are other factors involved, like how long you held onto the property and how much money you paid for it, that can affect whether or not you have to pay capital gains tax on your property. Understanding what property is taxed. The first step in avoiding capital gains tax is to understand what property is taxed. The IRS has a list of properties that are taxed, and it's important to take the time to go over the list. Capital gains tax can apply to residential property, homes, condos, etc. Rentals. Outdoor advertising structures. Farmland. Understanding how to calculate capital gains tax. It's not always clear how to calculate capital gains tax, especially if you're unsure of what type of property you're selling. Luckily, there are a few things you can do to make sure you're understanding the process correctly. If you're looking at your gain from the sale of personal property, it's going to be straightforward because there are no capital gains tax rates on personal items. You'll also want to keep in mind the date of acquisition. This will affect how much time is considered as a holding period. If you're looking at your gain from the sale of real estate, then that's going to be a little more complicated because it's based on capital gains tax rates and interest rates. For example, if the interest rate was 5% and your capital gains tax rate was 15%, then you would pay a total of 25% for taxes on the gain from your property sale. If these numbers confuse you or you need help understanding them, talk to a local accountant or financial advisor who can help walk through this with you. The difference between long-term and short-term capital gains. The difference between long-term and short-term capital gains is the amount of time the property was owned. If you've owned it less than a year, then your gain is considered to be short-term and taxed as ordinary income, kind of like a salary, and if you own it for more than a year, then your gain is considered to be long-term and taxed at a different rate. 1. The first thing you need to do is make sure you're using the right form. Schedule D. It's for any capital gains or losses from property, stocks, or bonds that weren't taxed as ordinary income. 2. Report all sales on the same form. This means if you sell one residential property, but also sell some other type of property, such as stock shares, these should still be reported on Schedule D and not on another form. 3. Remember to include any proceeds from the sale of the property in the cost basis calculation. So if you sold an apartment building for $5 million and had depreciated $4 million over 10 years, your cost basis would be $1 million. 4. Depending on how much in taxes are owed on this method, it may be beneficial to have an accountant prepare your taxes for this process to avoid any penalties or fines associated with incorrectly filling out forms. The difference between personal and investment property. The type of property you have dictates whether or not you have to pay capital gains tax. Personal property includes your home, car, or other things that you use for personal purposes. You don't have to pay any capital gains taxes on these types of properties. Investment property includes anything that's not personal property. This can include stocks, real estate, bonds, collectibles, etc. If you're selling an investment property, there are two methods used to calculate the capital gain: cost basis method and sales proceeds method. The cost basis method is the more common method used when calculating capital gains tax on investment properties. Cost basis method. If you use the cost basis method to compute your capital gains, it involves adding up what you originally paid for the asset and subtracting what you sold it for, including any fees. The difference is then taxed at your income bracket's rate. For example, if you made $5,000 off of a $50,000 investment property sale, and you're in the 10% income bracket, then $500 will be considered taxable income at 10%. Sales proceeds method. This method differs from the cost basis method in that it doesn't take into account what you originally paid for the asset when figuring out your taxable income, only what you sold it for. With this method, if we were using our previous example and assuming that there were no additional fees when selling your property, then $5,000 would be considered taxable. Tips for avoiding capital gains tax when selling your property in California. 1. You only pay capital gains tax if the property was classified as a capital asset. 2. If you bought your property as a business investment, you will not be taxed. 3. If the property you're selling is your home, there are no capital gains taxes to be paid. 4. You can defer paying capital gains on the property if you reinvest it in another property or other type of investment within 180 days. 5. Make sure to use the first in first out method to determine the cost basis and profit when doing your taxes for your property sale. 6. Any profit from a sale is considered long-term if it's been held for more than 1 year and then sold at a profit that doesn't go over $250,000 for an individual or $500,000 for a married couple filing jointly. These profits are only taxed at 15%. 7. Any profit from a sale is considered short-term if it's been held less than 1 year and then sold at a profit. These profits are usually taxed at 25%. 8. The gain from short-term transactions is taxable as ordinary income and will be taxed as such if it exceeds certain thresholds set by the IRS each year. Meaning those over thresholds would now be paying 39% in federal income tax plus California state income tax, as well as other local taxes depending on where they live. Conclusion. You can avoid capital gains tax on property in California by understanding the tax, understanding what property is taxed, understanding how to calculate capital gains tax, the difference between long-term and short-term capital gains, the difference between personal and investment property,